What's up, investors? As always, it's the one and only the Russian dude, and in this episode of the Communistic Capitalism, we're gonna be talking about why and when and how I predicted this stock market crash, which we still don't know if it's gonna crash or not, but we definitely saw very big decline today. In the S&P 500 is more than 2%, some stocks are even down to double digits. So is this the beginning of the end? Or is it just one-time thing? We're gonna find out the next week. But as a general rule, the way the stock market closes on Friday night, this sets the behavior, let's say, so the performance of the stock market for the whole next week. So let's see if it's gonna come true. If not, you know there are many reasons why stocks went down today, including the new disease, new variant of disease, let's say, so the Chinese delisting DIDI, I mean making them to be delisted from the New York Stock Exchange, and some other things, including but not limited to Jerome Powell being renominated as the Federal Reserve Chairman for the second term in a row. And today, in this specifically this episode of the Communistic Capitalism, I'm gonna be summarizing all my previous live streams, which started, yes, more than 100 days ago, more than 3 months ago. I started seeing the signs of potential stock market correction or crash or whatever you wanna call it. I don't think it's gonna be a recession or anything, but who knows. And I'm gonna be summarizing all the points that I've made during the past 3 months. And as you can see today, I'm still wearing my red t-shirt. I think I mentioned a couple of live streams ago that whenever the market is down, I want to wear red. Whenever the market is up, I want to wear obviously green. And I honestly have only one green t-shirt in my wardrobe. So as you can see, most of the times it's gonna be the red one. And specifically today, it definitely makes sense why I wear the red one. Okay, so another thing is that let's make it beer and stocks. I have this one glass of beer. And as soon as it's done, the live stream is over, because I know 1 hour live streams, it's kind of boring maybe for everyone. So let's try to make them 30 minutes or something, and then we see how it goes. Okay, this is not bad IPA, by the way. Okay, so to begin the live stream, I want to show you first of all my video that I made 2 weeks ago. So right now, to make it more sense what I'm talking about. Right now I'm gonna show the live stream of 2 weeks ago, when I was talking about that the Chinese government, the Chinese country, let's say so, decided to launch a new stock exchange in Beijing. And at that moment it was like, okay, it's not a big deal, so what, it's one more stock exchange. But at that time I mentioned that this could be the reason, the beginning of what Chinese government will say in the future to most of their companies that are listed abroad. And the Chinese government will tell them, okay, we have the exchanges back in our home country. Beijing Stock Exchange, Hong Kong Stock Exchange, and all these stock exchanges that Chinese country, they do have their own stock exchange. So it's not necessarily that Chinese companies need to be only listed in the New York Stock Exchange or NASDAQ. So for this reason, I was telling you that this might be the beginning, that the Chinese government will start forcing Chinese companies to be delisted from American, and especially from American stock exchanges, to be back home. And so let's watch this part of the live stream. I don't know, I've never shared my screen with the audio, with the sound, so let's see if it's gonna work. Okay. It's very unpredictable. So what stops them from saying, okay, Alibaba, you cannot be traded anymore anywhere except China, so go back to China. And that's it. Just like this, in 1 week, they might cancel like a presence of Alibaba in anywhere else except China, which basically means if your portfolio has, if you have, I mean, Alibaba stock shares, and if you are not like qualified investor, if you do not have like some sophisticated brokerages, maybe like interactive brokers or something like this, if you have like more than half of people in the US have like their Robinhood accounts, which only like have access to just very regular, just classic exchanges, if they have Alibaba, they'll be just stuck with these shares, not being able to sell. Okay, and this is exactly what I was saying, as you can see right here, November 12th, 2021. So as you can see, I'm proving whatever I'm saying, my words, with actual facts. And now I'm showing that there was a fact, there was a moment in the past when I said that creation of this stock exchange might trigger many Chinese companies to be delisted. And one of the first one, maybe it's one of the first one of many to come, was the DIDI. So now we see that Chinese government is pressuring them to be delisted, and this is just one of the potential signals why the stock market has crashed today. So, but let's start with some more graphs, charts, and news headlines, as I always do. Always whatever I'm showing you is gonna be with the proof and everything. Okay, I think I'm still showing my screen. Let me just open the... I should have opened this in advance, but okay. Okay, so this was the beautiful picture we saw today. Everything is red, just like it needs to be on the stock market, which was growing non-stop for the last year and a half. Today we see that almost everything except the disease stocks, which are like Moderna, Pfizer, I know, Netflix, and even Peloton, which is the bike company, but not just the bike company, like Peloton fanboys will say. Everything went basically down. Moderna once again went up by 20.5% by dropping previously for like what, no, almost half in price. It went up by 20% once again. But the rest of the market, the S&P 500 especially, it went down, and as you can see, everything went down significantly, 2-3%. So the next one of the major fears is why the market is crashing. It is because of the disease, and I don't want to say it out loud because then YouTube is gonna flag my video, and I already not getting any views at all. And if the YouTube flags my videos and not recommends them, not suggest them to anyone else, I would get like, I don't know, 3-5 views. But we need to share this information. So if YouTube flags my videos, share this video with as many people as you want, because I want to make you be prepared. I don't tell that, okay, the crash is gonna happen next week on Monday. I'm saying that there is a good possibility this can happen, and especially when this starts happening, and we will talk about this very soon, especially when this starts happening, algorithms will take place instead of people trading, because in the developed stock exchange, like in the US stock exchange and the US stock market, more than 80% of trades are done because of algorithms and robots. So which basically means as soon as some support resistance levels are reached, as soon as they are breached all the way down, the algorithms are triggered to sell, which creates more selling pressure. And then retail investors will start panicking, selling as well. So, but we will talk this about this in the very nearest future, like, I don't know, 5-10 minutes, just give me a chance. So, first of all, this was this. So, Belgium confirms new cases of this disease. The next one was Canada is moving travel from Southern Africa. Then obviously it was Portugal announcing new restrictions. Then UK and Israel improve to once again alleviate, let's say, so restrictions with the travel with Southern Africa. And because of this, even whenever there's like massive new cases in Europe, it's like record high since the beginning of the whole lockdown pandemic. I hope this word is not banned or anything by YouTube algorithms, even though we still now see the biggest number growth of new patients, let's call them like this. I'm just trying to be as politically correct for the YouTube algorithm as possible. So in addition to seeing maximum number of cases right now, we have a new variant which is extremely contagious, extremely easy to spread. So this once again brings the fear that the economy might shut down, people will get laid off, there is not gonna be too many people working, the factories will close, the stores will close, there's not gonna be any activity, and then it's all once again so much money was printed. It all went to nothing, obviously, because of the inflation, like 6.2%, so much money that no one needs anymore. And now the economy shuts down again, and then it's all the way since the beginning once again. But this time, because the money already is not going to be the solution, it's already printed so much, this time it might be worse than the previous time, the original 2020. So, and as you can see, not just the S&P 500, not just American index stock market crashed, but every single stock index around the world crashed as well. Toronto, Dow Jones, Nasdaq, S&P 500, FTSE, so-called European index, Shenzhen, Shanghai, Hong Kong indexes, almost everything crashed. And Jamie Walkerdine. What's up, Jamie Walkerdine? Thank you so much for joining. Thank you so much for watching this live stream. It might be a flash crash, and in my next slides, in around like 5-10 slides, whatever, I'm gonna be bringing more points why, if this is not a flash crash, this can be the beginning of actual stock market correction, or even a crash which is like 20% down indexes. So just stay until the end. It's gonna be a short live stream. I'm just drinking the beer, and as soon as I'm done, the live stream is gonna be over. So by the way, it's Friday, so if you have any beer, just grab a beer with me. Every time I make a sip, you make the sip, and we're gonna be just like buddies talking to each other. Okay. Oh, hello, Scott. Thank you so much, Scott, for watching this once again. Thank you so much for having me on your live stream last Saturday. Everyone go check Scott's channel. He is breaking down companies for you, individual stock analysis. This is the stock analysis that I personally prefer. Just straight to the point, whatever I need to know. No like being like Tesla fanboys or anything like this. Like straight to the point analysis, without being in love with the stock or hating the stock, just pure numbers, pure what the company is doing, future plans, and all these kind of things. So if you need this kind of analysis, Scott's stock due diligence is the channel you need to watch. Okay, and so besides the markets crashing, obviously all the way around the world, everywhere and around the world, the cryptocurrencies are also crashing. So as you can see, for example, Bitcoin is down, and this was the screenshot of basically what today is the 26th, yes. So this was the screenshot a couple of hours ago. So right now I think it's supposedly around the same price, but even the cryptocurrencies crashed. As you can see, this was the spike when all the new disease came out, when all the other bad things came out about Chinese being delisted. So this is when the Bitcoin crashed additional approximately like $3,000-4,000, which is like 7-8%, I would say, in just like less than a day. So, and this triggered positions liquidations, and this is why I think that if this is not a flash crash, this can bring the beginning of the end. And let me see, I have some questions in the chat right now. So Mr. Araya, thank you so much, welcome back, Mr. Araya. Scott's videos are great too. Absolutely, I agree with you, Mr. Raya. Great videos. Every time I need to do a quick research about individual company, in 80% of the times I see the Scott's video. Unless he doesn't have a video about the company, then well, obviously I cannot see the video of Scott. And Jamie Walker says he bought Amex today in the flash crash. I am stupid or smart. It is impossible to know if you're stupid or smart. Definitely you're not stupid because you're buying American Express, which is a relatively good company. It's like one of these credit cards that everyone is using. So I haven't seen the fundamentals, the financials of this company, but knowing how much in demand this company is, yes, it is a titan of its industry. This company might not go up and down 20% in one single day. But what I know is that American Express, along with Visa and MasterCard, they're here to stay. And it's going to be very, very hard and very long process of removing them from their top 3 positions of payment systems, let's call it this, of credit cards. So most likely it's not gonna go anywhere. Most likely you're not gonna see 50% decline. Just hold for now because it's very huge uncertainty right now in the future. Just hold for now. I will be very, very cautious about buying something new. And Scott says thank you. Anytime, Scott. Thank you so much, you first of all, for having me on your live stream last time. Okay, now back to positions liquidations. So I was speaking about 5 minutes ago. I was speaking about that 80% of trades on the US stock exchanges, on the US stock market, is because of the algorithms and robots, which basically means what this means. Let's say so we have the S&P 500. It's just obviously oversimplified example. Let's say so we have the S&P 500. And right now it is, if I'm not mistaken, around 4,500, the index, okay? Like 2 days ago it was 4,700, and it was in this range for like a couple of weeks. It was going up 50, going down 50, going up 50, going down 50, and so on. So, but there are algorithms that are said that as soon as the S&P 500 breaches 4,000, let's say so 300 and goes down, the algorithms will be triggered to start selling, let's say so the VOO, for example. Once again, just the very oversimplified example. And VOO is the ETF for the S&P 500. So, which basically means that as soon as it reaches 4,300, the decline will be accelerated all the way to depending how many algorithms were set at this 4,300. If every single algorithm of, I don't know, Goldman Sachs, JP Morgan, Wells Fargo, BlackRock, if every single algorithm is set at 4,300, and as soon as this is reached, the decline will be sharp. It's going to be just vertical, going down all the way to, I don't know, like 3,800, because it's going to be billions of dollars sold almost at once immediately. Obviously, this is going to create a huge decline, but obviously algorithms are not set specifically to these numbers. Some of them, for example, JP Morgan is set at 4,400. Wells Fargo is like 4,300. BlackRock is like 4,100. And so many different hedge funds, mutual funds, pension funds, they have their different levels for support for the S&P 500. But as soon as one of them is reached, the one which is more common, which is, let's say, so once again, 4,300, then we see accelerated liquidation of assets, which basically happened right here with the Bitcoin. So as you can see, because Bitcoin fell below $55,000, so many algorithms, including Binance, OKX, Bybit, FTX, BitMEX, I guess these are all crypto exchanges, they were triggered, their own algorithms were triggered to sell Bitcoin. And because of this, if we go back right now, from 55,000, the price went down, as you can see, almost immediately sharp down because of the algorithms. Algorithms sold it, and the price was crashing, I don't know, $500 per day, let's say so. But as soon as its price reached 55,000, this 500 decline happened almost like in 5 minutes, let's say so, because of the algorithms. And not just in the crypto world, especially in the stocks world, these algorithms are also existing, which basically means as soon as some stocks reach certain level, algorithms are triggered to sell, which basically accelerates the decline. Okay, now let's go to the next slide after I have one more sip. Okay, so this was about the cryptocurrencies and about the algorithm trading. But now let's speak about China. What some people also talk about right now, why this was the reason why the stock market crashed, because of China, because of Beijing pressing DIDI to deliver from the US stock exchange over data security fears. Obviously, data security, not too many people care about this because it's like, I don't know. Whatever, let's not go into politics. But long story short, 2 weeks ago, like I mentioned, if you've been present since the beginning of my live stream, I mentioned exactly 2 weeks ago, during the same live stream, I said that the Chinese government decided to create the Beijing Stock Exchange, okay? And so the creation of this stock exchange meant that probably Chinese government will start forcing Chinese companies that are listed abroad to come back home. Which basically means, and this is what we see at this very moment, that DIDI was one of the first ones. Maybe all the other Chinese companies, especially major ones, will be delisted as well in the nearest future. But we already see that DIDI was the first martyr, if you want to call it like this, to be delisted. So the stock obviously went down, everyone is uncertain, everyone is fearful. All the Chinese companies also fell down, followed the DIDI because of being risks of being delisted. Because being delisted from the New York Stock Exchange means that investors, retail investors, I'm talking about Robinhood boys, Tesla fund boys, all these people, they will be stuck with these stocks not being able to trade them at all. Unless you have a very sophisticated exchange, brokerage, I mean, like let's say so interactive broker, where you can have access to different stock exchanges, not just the New York Stock Exchange. You will not be able to sell Chinese, you will not be, let's generalize, you will not be able to sell stocks of delisted companies. You will just have them in your portfolio and they'll be like dead weight. You'll not be able to do anything about them. So if you have right now Alibaba and you're just using Robinhood, I know, or well, Simple if you're from Canada, and if Alibaba gets delisted, you will most likely get stuck with this stock not being able to sell it. And this is what's so fearful for so many investors. Yes, you can go through the long route. You can, for example, open an account with the interactive broker and contact the customer support, ask them to transfer shares from your Wealthsimple or Robinhood account to your interactive broker's account, and then maybe you will be able to sell them, because after all, you are buying actual shares. So it's not just like you're buying some into the numbers. You actually are a share owner, shareholder. So which basically means you can transfer them between brokerages. But long story short, many retail investors, they do not want to deal with this kind of stuff. Obviously, it's kind of complicated. And for example, if you need to open an account with interactive brokers, I think that the minimum balance you need to have just to open the account is $10,000, maybe even more. So for this reason, many people just decide to sell now, lock in losses if they have any, and just be at peace with this. Okay, and so this is about the second reason why the stock market possibly can crash, because so many Chinese companies can be delisted, and this creates fear and uncertainty among investors. Another thing about Chinese companies and Chinese overall economic condition is the Evergrande. So many financial YouTubers were thinking that they're smart when they're speaking about Evergrande and speaking about bonds. Like, they all speak about stocks, you know it. Like, financial YouTubers are like Tesla, Palantir, I don't know what they're like, Rivian, the most popular one, Peloton, all this garbage basically. No, well, some of these companies are not garbage, obviously. Some of these companies are great companies. But the reason why they're garbage is because they're so significantly overvalued. It's like the next book on my list, just a little bit off topic. The next book on my list, after I finished reading the book about Elon Musk autobiography. I am not investing in Tesla. I like Tesla as a company. I don't like it as a stock. And still, I want to know more about Elon Musk, about Tesla, about his company. So I am reading, I'm doing the research, but I'm still not gonna buy Tesla at this point 100%. So, and the next book after this book I want to read is the history of stock market crashes, which is all the way since the tulip mania in Netherlands, which was like in 16th, 17th century, or maybe even earlier than this. And this book focuses on the stock market crashes, describes what inflated the bubble and what made the bubble burst. And every single one of this crash, people were saying, this time is different. This time is different. Like whenever internet stocks.com bubble, people were saying like, oh, internet is the future. This time it's different. All these companies, they deserve the valuation they receive. The dot-com bubble burst, many companies were terminated, they declared bankruptcies and all this kind of stuff. Some companies which still were able to survive, like Cisco, they never recovered to the previous prices that they had 20 plus years ago. They still never recovered to the same prices. And now we see the same stuff. Electric vehicles, Rivian goes public, the valuation $150 billion in 2 days, not a single sale, and people say once again, this time is different. No, this time it's not different. This time is the same. This time is the same. It's just the moment, it's just the matter of time when this bubble is gonna burst. It's just a matter of time what's gonna be the black swan. It's just a matter of time when the market starts correcting and the most inflated industry, which is at this point no doubt is the electric vehicles, will decline by, some auto manufacturers will decline by 90% or even more. So we're gonna see, I don't know, like, I know people say Tesla is not just a car company, but we might see Tesla going back to $100 billion valuation, $400 billion value, which basically means that the stock price will be like around $400 or less. We very well possible might see this happen. We absolutely possible to see, it is absolutely possible to see that the stock price of Tesla might go down to like $300, and then not being able to recover to the same levels it is right now for the next 20-30 years. And I know that all the YouTubers, all the Tesla fanboys, all the Elon lovers, they're saying that their cost basis for Tesla is like $50. They bought Tesla back in 2005. Like, I know, all the Tesla fanboys are exactly the same. They bought Tesla when it was $50 per share and they never bought more. But those people who are buying Tesla right now, they're risking so much. Tesla might go additional, like, I don't know, 20% up, 30% up, 40% up, I don't know, maximum. I don't see Tesla being $3 trillion company. I don't see Tesla being the biggest company in the world. It might happen momentarily, but eventually when the market realizes that this is a little bit inflated, to say the least, Tesla might as well crash to, like I said, $200-300 billion, making the stock price $200-300 per share. So they are risking right now getting additional 20% return, risking that the stock can crash 80-90%. For me, it's absolutely not worth it. Whenever trading, I'm not trading, but whenever you are doing trading, the good risk-reward ratio is 3-to-1, which basically means you can, let's say so, triple your capital by losing like half of your capital. 3-to-1 risk reward ratio. In this case, the risk reward, in Tesla case, the risk reward ratio is negative. You are risking 20% upside for 80% downside. Tesla fanboys will hate me. Whenever people are watching this stream and the recording of the live stream, they're gonna stop watching me at this moment, or they already stopped watching at this moment, because Tesla is a cult. It is impossible to change the mind of Tesla fanboys, but every time I'm doing the live stream, every time I start talking about Tesla, it takes me 15 minutes to finish, so apologizing. Let's get back to the stock market correction, stock market crash. Okay, let's see, I have some more comments. Let me bring my laptop right here. And Jamie says that China making their big company delist sounds like a real dangerous idea for them. Wouldn't it permanently ruin the already low trust investors have in their market? I know what you're talking about. Yes, this might ruin the trust of investors. Right now, at this very moment, the only reason so many people still are invested in China, it is because the Chinese companies are so undervalued. You see all these great companies with extremely low multipliers. They're like, they have PE, like seeing the great Chinese company with the PE ratio of more than 10, it's already, you're thinking like this company is already overvalued. So Chinese companies are so undervalued right now, which is once again the only reason why so many people are still invested. They're ready to take this risk of investing in an extremely undervalued company, which is extremely good company, taking the risk because Chinese government is very unpredictable. And yes, first of all, also it's worth mentioning that hopefully all these financial reports that Chinese companies are issuing, hopefully all these reports are true, because we might not know, maybe all these numbers are just taken out of hat, or like created out of nowhere, created out of thin air. We're never gonna know it. Maybe that's why the multipliers are so low. So yes, long story short, I do not have an exposure to a single Chinese company at this very moment, but I do have an ETF for Chinese internet companies, which once again includes all this Alibaba, Tencent, Vipshop, JD.com, and all this kind of stuff. Baidu, and obviously all this kind of stuff. So yes, I do not have exposure to any single individual company, but I do have this big ETF because I do not want to bet on a single company. If I want to be invested in Chinese stocks, ETFs, I want to have just bigger exposure. I don't want to risk so much. But yes, if something bad happens, this will definitely ruin the expectations or the trust for investors for the Chinese companies, and this can definitely bring the Chinese stock market all the way to the down and be this companies not being able to recover for the next 20-30 years. Just look at Japanese example. Japanese stock market still hasn't recovered in 30-40 years. And next one, Jamie says that Tesla holders tell me I'm missing out and missing the bus, and when I ask them to explain their valuations of Tesla and the financials, they just post a graph of the stock price. Exactly. This is the perfect example of Tesla fanboys. You ask them if this is a, let's be not that politically correct, if this is a stupid Tesla fanboy, Elon Musk fanboy, whatever the guy, you ask him why invest in Tesla, and he's like, well, the stock is growing, Tesla is not just a car company. These are the people I just prefer to ignore, to block them and never speak to them again, because arguing with the fool, and if you are arguing with the fool, you need to ask yourself, who is the fool in this argument? But if there are sophisticated Tesla boys, I've seen some sophisticated Tesla boys, I've seen some smart people who are Tesla boys. Because whenever you're invested in something and you see it growing all the time, you just focus on everything. Let me put myself on the screen because we are going about Tesla once again for a long time. So whenever you're arguing with smart Tesla boy, the only response that you get from these people is that it's not just a car company. And then they start bringing, Tesla brings the insurance, Tesla revolutionizes the electric vehicle, Tesla creates batteries, Tesla sells, I don't know, like this, whatever it's called, I forgot, doesn't matter. Tesla sells solar panels, Tesla creates these tunnels between Los Angeles and Las Vegas, whatever, to travel yourself at speed of light. Elon Musk is the genius, this and this and that. Yes, all this is kinda correct, but it still does not justify the valuation what they have right now. If you are invested in Tesla since $200, okay, good for you, keep being invested, but don't say new people that you need to buy Tesla, it's 1,200 per stock, or like whatever the price right now, $1 trillion company, first ever junk rated company to reach $1 trillion valuation. This is insane. Like, Tesla right now is more than top 20 car manufacturers combined, while only making like what, 3%, 5% of total sales that all these companies do. So obviously this is a ridiculous comparison, but it is what it is. Long story short, Tesla, good company, bad stock price, and there is no way Tesla fanboys will make me strong arm into investing in this company on anything above like $300, $400, $500 maximum. If Tesla reaches $500, I will consider investing in it. $400, I will maybe buy a couple of shares. $300, yes, I might buy it into Tesla, get it like a couple of percent of my portfolio, no more than this. Yes, I'm feeling that I missed out on Tesla. I saw Tesla back in February of 2020 when before split it was, I don't know, like $300 stock, basically, maybe even less than $200 stock. This was the first time Tesla came on my radar. Yes, I should have invested, but even at that time, even at $200 per stock, I still thought that this was overvalued. So yeah, I feel bad about missing on this, but I still have some great companies which also grow pretty good. So I'm like, yes, once again, I feel bad, but I'm not gonna invest in Tesla at this point. Okay, Jamie says, I respond to their graphs by showing them graphs of Cisco. Yes, exactly, show them the Cisco graph, but it's still not gonna be enough for them because they're such fanboys. As long as they don't see the big decline, they always think that this is gonna grow non-stop. And then when you bring up dot-com bubble, they say, but what about Amazon? Yes, some companies survive, some companies don't. Tesla might survive, but who knows, maybe Tesla will follow the example of Cisco, maybe Tesla follow the example of Amazon, but I do not see, once again, Tesla being like $3 trillion. There are some psychopaths, like actual psychopaths, like I don't have any other name than this. There are actual psychopaths who think that Tesla can be $20,000 stock. Let me drink beer after saying this out loud. There are psychopaths who say that Tesla is a $20,000 stock, which basically means that Tesla can reach $20 trillion valuation. Which basically means that Tesla can be like what, 40-50% of total US GDP at that time, whatever is the GDP growth rate is gonna be. Can you imagine one company being half of the US GDP? I can't. But they're so convinced, they cannot imagine their lives without Elon. Let them be like this, I don't know. Good luck to them. Okay, let's get back to what we came here for, because yes, Tesla takes so much time and energy from me. Okay. Okay, where is it? Okay, so Positions Liquidated, DIDI, blah blah blah, China. Okay, Evergrande. Evergrande, we all heard about Evergrande. This is the real estate developing company that builds houses, basically, builds apartments, builds buildings. So it was on the brink of default, not being able to pay for its the bonds. And so we also saw that the owner of China, Evergrande, sold 9% stake in his company for $344 million amid debt crunch. So some people just missed this news, but what they definitely never heard about is that the same guy, Evergrande founder, sells off personal assets, raising $1.1 billion for company use. What this means? This means that this guy sold his assets, which are like apartments, houses, mansions, cars, whatever, maybe some his savings or whatever. He got money just to give it to his company, just to help us stay afloat. And like, I'm not sure how much of this 1.1 billion will go towards paying down the debt. But long story short, when the owner of the company, when this top executive sells his own personal assets just to cover the debt of the company, which is still way more than $1.1 billion, this is pretty bad sign, to say the least. And Chinese real estate bond market is in billions, if not trillions of dollars. And 70% of this bond market is rated as junk. Chinese real estate market is the biggest asset class in the world. If I'm not mistaken, correct me if I'm wrong, go check on Google. At this very moment, it is valued at $55 trillion. And imagine that bonds of this market, 70% of total bonds of this market is rated as junk, which basically means high risk of default. And Evergrande is just one of the first one. There was another one, Fantasia, whatever you want to call it, Fantasia. There was another one, this also came into obscurity, no one talks about it anymore. People still talk about Evergrande, at least. So this guy sells his personal assets just to help the company pay down the debt. Every single YouTuber like Kit Mevin, Nomtash, like all these like popular YouTubers, like you know how I'm talking about, some specifically changing their names, so I don't know, YouTube algorithm doesn't catch up on them names or something. I don't care, to be honest. All they say is that, okay, Evergrande paid down their bonds, the Evergrande evaded the default, that's it, Evergrande crisis is over, Chinese real estate market recovered. What they don't know is that this Evergrande, they just made one of their payments for bonds, which was like several $millions. And they barely made it. They made their final bond payments like 1-2 minutes before they were being declared at default. So literally Nomtash, you know how I'm talking about, Jamie. So long story short, literally 2 minutes before Evergrande was declared to be a default, they were able to just get some money out of like people on the street. Hey, give me some money, we need to make some bond payments, coupon payments. 2 minutes before default, they were able to make their bond payments. The next bond payment is gonna be later, but they barely made these ones, and YouTubers were like, okay, that's it, Evergrande is back to normal. All good, don't worry, there is no stock market crash. But if you watch some of my previous live streams, I was showing, because right now I don't have this graph, Evergrande still faces billions, and I'm talking actually billions of dollars of bond payments. In addition, because the way bonds work, you need to make coupon payments every month or every quarter, every year, and in the end, you need to return the principal amount, which basically you need to return every bond to the holders of the bonds. You need to return the principal, the original amount. And long story short, this is billions of dollars that Evergrande is still facing to pay. And they barely made several millions of dollars in payments. How they're gonna make the next payments, I have no idea. But financial investing YouTubers, they tell you everything is normal because Tesla is going up no matter what. Okay, next one. This was the second reason why the stock market might be crashing. The third reason, Jerome Powell, our favorite never-ending money printer in human form, Jerome Powell. The Jerome Powell, Mr. Brr guy who prints money no matter what happens, who doesn't see the inflation, who doesn't want to stop money printing. He was doing this just not to crash the stock market, let's say so. He was doing this all the way until he was being renominated. He was like, okay, I'm gonna print money. There's no way at the end of my career, at the end of my term, I'm gonna crash the stock market because I'm definitely not getting renominated. As soon as he got renominated, as you can see, Biden picks Jerome Powell to lead the Fed for a second term as the US battles the virus and the inflation. And this was this Monday, like 4 days ago. So long story short, Jerome Powell was like, okay, I am back in business. I have the Federal Reserve once again. I have access to printing brr machine once again. Let's party. Now that's it. I have another 4 years in my pocket. Now we can do whatever we want. And the next news coming like literally 2 days later, more Federal Reserve officials open to speeding up bond buying taper. Which basically means one of the reasons that the stock market might crash or correct itself 10, 15, 20%, it is because of tapering, which comes in two phases. First, it's the tapering, which basically means to reduce the money printing. Originally, right now, previously, I mean, when the money printing was at its fullest, it was $120 billion per month worth of buying treasuries and mortgage-backed securities from the market to create the liquidity to give money to the market, which in simple terms is money printing, $120 billion per month. When the taper was announced, it was supposed to decrease by $15 billion per month. And as soon as Jerome Powell, 2 days later, they say, okay, now let's accelerate to $30 billion per month. Which basically means that they technically, if this is agreed upon, they can stop all the money printing all at once, like 4 months later, which is way faster than they originally anticipated, which was supposed to be until summer of 2022. And the second stage of quantitative tightening, which is the opposite of quantitative easing, which some financial YouTubers don't mention this, but okay. Okay, let's not diss anyone. So, and then the second phase is to increase the interest rates. And my previous live stream, I was talking about what happens when the interest rates go up. Which companies will benefit from this? Which companies will be devastated from this? And the companies which will be devastated from this are the ones which bring the entire stock market up, which are tech companies. They will absolutely not benefit from the interest rates go up. And this will be the second stage of quantitative tightening, to increase the interest rates, which basically means as soon as the money printing stops, which is supposedly happen in 4 or 5 months, a little bit later, a couple of months later, they need to increase the interest rates to combat the inflation, which once again decreases significantly the income of technological, biopharmaceutical, or any other capital-intensive companies, including those top 5 companies, FANG companies that bring the entire S&P 500 index up. As soon as they fall, the rest follows them as well. So as soon as this happens, and once again, Jerome Powell is like, okay, I got my second term, I don't care about crashing the market, let's do it right now, let's Leroy Jenkins into the stock market, and then we see what it goes, because right now I have my job secured for another 4 years. Okay, and now the danger why the stock market can crash. Okay, Mr. Arai, I bet you love Millennial Monday. 4 Millennial Monday boys. Okay, so I know who you are talking about. Andre Jik, Meet Kevin, Jeremy Financial Education, and Graham Stephan. Yes, I do like them, especially Andre Jik and Jeremy, and Graham Stephan, let's say so as well. Meet Kevin is like, he's making all kinds of videos, like he's the smartest from all of them. He's the smartest from all of them. It's 100%. But he's making all kinds of videos, so like, if the market is crashing, he's gonna be making crashing videos. If the market is going up, he's gonna be making market going up videos. If the market is neutral, he's gonna make 2 videos. One of them is gonna be market is gonna crash soon, and the next day he's gonna be making stock market is rallying up by now. So, which basically means he makes videos for both sides, if the market goes up and if the market goes down, so that in the future, when some of these 2 scenarios happen, he can refer back to his original video and tell you, I told you so, I told you the market is gonna crash. Or like if the market is going up, he's gonna put some fragment of his previous video telling that he thinks that the market is gonna go up, and he's like, I told you the market is gonna go up. So yeah, Meet Kevin is funny. I'm watching him just purely for the news updates. I don't watch him for like stock market advice. I don't invest in company he invests in, because in this case he's just a YouTuber. He's just attention seeker person. I just watch him for like updates, and recently I slowed down watching him because he just uploads so many videos. Andrei Jik is just homie. another Russian guy, so yeah, I watch him of this as well. Graham Stephan is just classic, I know, like personal finance person, I watch him from time to time. And Jeremy from these 4, he is the one who is the most realistic, let's say. So Jeremy, I don't watch too many of your videos because I don't know why, but whatever. But Jeremy is the most realistic guy from these 4. Okay, Jamie, I think big blue chip tech companies will be okay. They have so much cash and little debt. And also, do you think it is good, bad for companies to have lots of tangible plus fixed assets in high interest times? Okay, very good question, Jamie. So there is not a single company that is too big to crash, too big to fall, too big to collapse, whatever you call it. Any of these companies can and most likely will crash, maybe not as much as small cap stocks, but they might as well go down. So the companies which will lose like 20, 30, 40% of their valuations will be obviously small, low liquid companies, which obviously no one talks about. These are the companies that will fall the most. Bigger companies like Apple I think, I'm not a trader, but Apple I think is always, every single day is one of these top 5 most traded stocks every single day. So which basically creates the liquidity. And liquidity means you can easily buy and easily sell. And by doing so, so many people, there's millions, hundreds of million shares traded per day, which basically means that if so many people are selling, at the same time so many people are buying, so maybe this will not create huge decline down like all the way like 20% one day, unless Apple says that, okay, we're gonna seize the company, we're gonna sell the company to, I don't know, Nikola, whatever. In this case, yeah, everyone sells Apple and then the company is terminated. This will never happen. But yes, and speaking about your lots of tangible plus fixed assets in high interest terms. So in this case, I think whatever you're referring to, let's say, so if you are referring to cars, fixed assets, for example, car equipment, I mean like factories or whatever is like this, okay? So maybe it's not the correct way of looking at this. In times of high interest rate, companies that are capital intensive are the ones which are gonna suffer the most. And these are the companies which you open, whenever you open the financial statements, you have balance sheet on the left, and on the right you have, you have balance sheet, on the left you have assets, and on the right you have liabilities, plus shareholders' equity. And what I mean by saying highly leveraged capital intensive companies are those companies that have debt, which is liabilities that exceed shareholders' equity. Shareholders' equity is the capital that the company owns, which either through selling stocks, bonds, or like investments from other people and other companies and stuff like this. But liabilities are mainly like loans, like bonds, once again, debt securities, or taking loans from banks, because they need to finance their operations. And those companies that have lots of loans from the bank, that borrow a lot from the bank, which has like, let's say, so 5 to 1, 4 to 1, like 80% of liabilities in comparison to shareholders' equity, they need to pay for this debt. And right now, let's say, so when the interest rates are so low, at this point, like 0.25%, plus whatever banks charge on top, I don't know, just to make an example, let's make it like 1.25%. Right now, for $100 million that they have, they pay 1.25% in interest per year, let's say, so to make it very simple, which basically $1.25 million in interest payments every single year. But as soon as the Federal Reserve increases the interest rates, and they're planning to do it maybe even twice next year, not just once, but twice, which means that they're going to increase first from 0.25 to 1.50, and the next time from 1.50 to 2.75. As soon as this just imaginary numbers, it might not happen, it might be more, it might be less. But if the interest rate is 2.75 and whatever banks charge on top is like 2%, now we have 4.75%, which means that interest payments per year right now, instead of $1.25 million, right now it's $4,750,000, which is more than I think, yes, exactly 3 times more, just because the interest rates went up because Federal Reserve started quantitative tightening. Just because of this thing, they are losing 3 more times money on their interest payments. This is what I meant by increased interest rates. Okay, and now back to this chart. Once again, this live stream unfortunately is already almost 1 hour long. I have no idea how to stop this this Tesla took so much from me today. But this is the inflows to equities. And let me take one more sip. Which basically shows how many people invested in the stock market. So many people came to the stock market recently. As soon as stock market collapsed in the beginning of 2020, as you can see right here, then so many YouTubers who are speaking, you need to invest, buy Tesla, buy, I don't know, Nikola, buy other stocks, whatever they want to promote, to pump or whatever. So many people came to the stock market. And this is literally the biggest number of people we saw in the history of the stock market. Almost every single person who has like a smartphone can download Robinhood at this moment, Wealthsimple if you're from Canada, Trading 212 if you're from Europe, and just invest in like 2 minutes. In 2 minutes you can become an investor at this time. Not like you don't need to call your broker by phone or anything like this. Just that's it. 5 minutes, you're an investor. So many people came to the stock market. So many people, unfortunately, are uneducated about the stock market, which basically means they just buy whatever stupid YouTubers tell them to buy, because some of them are just ridiculously unaware of what's anything happen in the world. Unfortunately, sorry about this, YouTubers, but you just don't know what you're talking about sometimes. Because of this, so many people are in the stocks. As soon as the bad things start happening, and they will eventually, because market cannot go up forever. As soon as the bad things start happening, all these YouTubers will be selling like, I sold all my position last week, like, or I shorted the stock market last week, I sold entire Tesla stock. People will start, without questioning themselves, start selling their stocks as well. And this creates another selling pressure, which brings us once again back to the algorithms. As soon as retail investors start selling, this will accelerate the decline in the total stock market, let's say so, the S&P 500 index. So from 4,700 it will go rapidly to 4,500. Algorithms will be triggered and they will send it all the way down to 4,300. Then retail investors will be like, okay, the stock market crashing even faster than we anticipated. Let's sell more. They will sell more, and then the S&P 500 is at 3,900, and then the algorithms will start selling again, bringing the S&P 500 all the way to 3,500. And then we see in 1 week 20-30% decline. People will fear, people will be scared, people will be selling everything, trying to save their money. Some people will never be back on the stock market because that's it, they just lost 2 years of worth of progress, and maybe they even lost even more than they originally invested. Some people will forever think that the stock market is a scam. All these YouTubers will be making like YouTube videos how they once again beat the market, made 200% average annual returns, how they're the smartest, how they sold all the way at the peak, how they shorted the market all the way at the peak, how they made 300 million% annual, like, I know, returns, whatever. We're gonna see all of this. The question is when. Couple more slides. So this is once again bringing me back about retail investors. So US technology on the right one, the small graph, you see that US technology sector fund flows in the trailing 2 weeks. And as you can see here, this includes mutual and funds selling trade, how it's called, not trade. Let me make it a little bit bigger so you can see. Okay, so this graph shows that there is an outflow, that actually big Wall Street whales actually sell technological stocks, what I call cool kid stocks, such as, I know, Nvidia, Tesla, Apple, Lucid, AMD, like Ford, especially Palantir, the most garbage company in the entire world. So funds, big Wall Street whales, actually sell these companies for the last 2 months, as you can see right here. And who are the ones who are buying these companies? Retail investors. Most popular stocks among individual investors in November. And we can see AMD, Nvidia, Apple, Lucid, Tesla, Ford, Palantir, PayPal, and so on and so forth. So, big Wall Street whales get rid of these overvalued stocks. And retail investors who watching Nom Taj, Kit Mavin, And all these like YouTubers, like I don't want to promote them, even though like who I'm gonna promote them, I'm the one who needs promotion. So all these retail investors who watch these YouTubers, they're like, whoa, Palantir is the future, Palantir is the next $500 trillion company, Palantir is the next quadrillion company. They are the ones who are buying this garbage. While smart money, I'm not saying Wall Street is a smart money. I'm saying that the Wall Street is manipulative money, but still, definitely I would say that Wall Street is a little bit more smart than just retail investors, unfortunately. Not maybe all of them. I know that every single person who is watching the live stream is smarter than Wall Street, because we are the real community of investing buddies. We are the ones who are actually smart, who are taking into consideration macroeconomics and all these kind of things. So we are the smart ones. So thank you so much for watching. You are smart ones. Thank you for watching. But regular ones, average Joes, John Does, Jane Does, they are the ones who are buying all this garbage. And the last slide, yes, or maybe that's it. I don't know, this one is not working. Let me open it again. Slide number 17. Okay, yes. And this is the last slide, just to summarize everything. Okay, and this is where major big investment banks, like banks, funds or whatever, this is where they think the S&P 500 can be by the end of 2020. So as you can see, everyone thinks like Bank of America 4,600, Bank of Montreal 5,300, Cantor Fitzgerald, first time I'm hearing about this, 4,800. So you can see everyone is thinking somewhere around 4,000 is the S&P 500 where it can be by the end of the next year. Will it go there? Will it not go there? Will it going to be higher than this? Will it going to be lower than this? We don't know. But what I definitely know at this very moment, that the stock market is extremely overvalued, It is so hard to find good deals, good new investments. I want to diversify my growth portfolio, but I cannot find too many deals because everything is so much overvalued. You cannot buy anything at this moment. Everything is so expensive at this moment. And then we have Chinese problems. Then we have never-ending virus disease problems. Then we have Jerome Powell being nominated again, which basically means that now, since he has his job, he does not need to fear anymore about crashing the stock market. So, my personal forecast, I think that by the end of 2020, we're gonna be no higher than we are right now, unfortunately. It might happen, it might not. I am not an oracle. I cannot see into the future. If I could see into the future, if I knew which company is going to be the next highest growing, fastest growing company of the next year, I will just invest all of my money into this single company. So as you can see, I cannot tell the future. But based on everything, based on macroeconomics, based on microeconomics, based on people's sentiment, based on whatever we see around ourselves, I think that unfortunately, I am the investor myself, so this will not benefit me either. But unfortunately, I don't see the S&P 500 being higher than it is right now by the end of the next year. And this is my conclusion, this is my forecast, this is my summary of all my previous live streams. Thanks so much for joining, thanks so much for watching. I hope you enjoyed, I hope some of this makes sense. I gotta go already, it's Friday, I have some things to do, same as you. Thanks so much for watching once again, and until next Friday. How do I stop the live stream? Okay.